And welcome everyone to this morning's Daily Market Report, brought to you on behalf of the Academy Financial Trading, in which we're going to take a look at some major movements to occur over the next 24 hours. But before we do that, at this point, if we can all, guys, embrace a quick risk warning to familiarise ourselves with the information in front, engage as much as we can, so that hereafter, any decisions you make in your trading are of a fully informed nature. So, on the cards for us this morning, folks, let's take a look at some economies. The value of those economies as is reflected by the value of their currency. Let's also take a look then at an energy. We'll have a look at crude oil for the same. Okay, whoops, wrong slide, guys. Let us switch to the platform now for an inspection of all those points. What we're looking at here in front, folks, okay, is the New Zealand dollar versus the US dollar. And we see really, over the last given period of time, okay, quite a significant movement, okay, which would be signaling strengthening of the US dollar versus weakening of the Kiwi, okay, or New Zealand dollar, or Kiwi, of course, is the slang nickname traders have for that currency. And what we really want to be interested in, and what we want to focus on, okay, is how does one capitalize on that movement, or on those movements, which is the essence of trading. But in order to capitalize on those movements, one has to know when those movements will occur with sufficient accuracy. And of course, for that then, we have the common indicators. In front of us, we're looking at the chart overlaid with a 100-day exponential moving average. This has been relatively accurate, as you can all see, with regard to signaling or being a support and resistance point in the market, but it isn't always accurate. And the question is, in times when it's not accurate, how can we effectively manage those losses, and how can we manage our risk? Well, that comes to position sizing, okay, which is a topic that we discuss here ourselves in our own educational packages. But what also can be done here is we can hedge our positions with the stochastic oscillator, such that when the stochastic oscillator signals overbought movements or oversold movements, we can catch those, which would be, of course, these secondary trends here overall, okay. Now let's take a look at crude oil. So, crude oil, guys, we see a huge weakening of price over the last given period of time, a fall in over 50% value. Now, in terms of looking, okay, for opportunities in this, we're using the 55-day exponential moving average coupled with the commodity channel index. And the commodity channel index usually shows when a market is range bound as opposed to trending, okay? So in this particular case, we could have used the commodity channel index signaling a return to ranging, okay? And we could have also used a 55-day EMA, but it would have been incorrect. And what we need to have in these times, okay, and in these times as well here, where the indicator had been incorrect, both of them that is a way to filter out what trades you will take and what trades you won't take. And one great way to do that is to not take trades based on a trend indicator when your previous trade has actually won. So we hope that's been of help, guys. If you have any further questions, please do not hesitate to get in touch. We welcome all inquiries. Have a terrific day, and as we say here, keep learning.